My name is Giacomo Marini. I've been here in Silicon Valley for a long time now, about 42 years. So I'll talk a little bit about a few things that I've learned about Silicon Valley, give you a little bit of a perspective of the Silicon Valley ecosystem, the venture capital business, and in the process I will also show you how often here in Silicon Valley what you do is several enterprises doing your entrepreneurial activity. So you just don't do one thing. You do one thing and then you go and do another thing, So I'll give you a little bit of a sense of that. Right now, I'm managing my investment firm, Noventi Ventures. I mostly invest my own money right now. I'm also, since 2021, president of the Ital Foundation, which is an organization of professionals here in Silicon Valley. The organization actually started before it was called the Silicon Valley Executive Council, started in 2004, and actually in 2005, 2006, started a collaboration in what was the Silicon Valley Study Tour, which is sort of the predecessor of the Silicon Valley Fellowship. So we try to help the Italian business community, to network and also to build a little bit of a bridge with Italy. Okay. So my entrepreneurial experience, I've done quite a few things, but there are three major legs, if you want, to my professional career. I came here as I started with two partners, another Italian and Swiss, Daniel Borel and Pierluigi Bacosta, Logitech in 2081. I moved here in 1982. That was the first, and then stayed with the company about 11 years. Then in 2002, I started Noventi Ventures, an investment firm, early stage investment. And then in 2006, I got involved with Inter Robotics, and then 2013, I went back in to run technology company, Inter Robotics, and then we ended up selling the company in 2017. I managed a couple of other companies in my career, but these are the most important ones. I've seen lots of entrepreneurs and lots of business plans. Been on the boards of lots of companies. In my investment career, as we will talk a little bit later, the funnel of startup investing is a very deep funnel. You start with a very large number of people coming to you with ideas and initiatives to make. So looked at more than 2,000 business plans to make 20, 25 investments, that type of stuff. So 1 out of 100. So Logitech, let's talk briefly about Logitech, a little bit of story. I'll tell you a little bit of curious things as well. So we started between Switzerland and Italy in 81, a Swiss and two Italians. When we moved to the US, we ended up going to a building that if you Google it, you'll find that it's the luckiest building in Silicon Valley. We were actually the first technology company in that building, and then after that, a number of other companies like Google, Danger, PayPal were in that building. So it's a small building that was owned actually by the people that then later started the plug and play incubator that you might have heard of. So when we came from Europe, one thing that we did not know, which is more typical of the United States, is focus. So we are doing all kinds of different things. We're doing some software, some hardware, we are doing some consulting, and at the same time trying to develop products. And that doesn't work in the US typically. In the US, people don't pay attention to you. They want you to be focused on one thing and talk about one thing. And that was one of the reasons why at the beginning we couldn't raise money. So people were just confused. When you decide what you want to do, okay, come back and we'll talk. Okay. After 2 or 3 years, I think the mouse as a product started carrying us. So we started selling it at the end of 82, by the way. But then in 84, it sort of started to become a little bit more significant. And in 85, we also entered the retail market in 85. And then we did an IPO in 1988. We were pretty small, but not so small. We were $40 million in revenues when we went public. Okay. So the founders of Logitech, people always say, okay, you invented the mouse. No, we did not invent the mouse. Okay, the mouse was invented by a gentleman called Doug Engelbart. Some of you might have heard of him, but he's not a very well-known name, but he invented lots of stuff. Okay, so if you look him up at DougEngelbart.org, you'll see what he has invented. And the mouse, this is the first mouse, was a wooden case, and it used two perpendicular rollers to track. And it was part, the mouse over there, it was part of this online system, which was a predecessor of many things. I mean, this is very, very early, this is 19. The mouse was invented in 1964. This system is 1968. Okay, so it's very early stuff. You see the screens were also round because they were not able to make the rectangular screens quite yet. Okay. So Logitech as a company, so when you think about company startups, new enterprises, so the companies have their own DNA. One of the DNA components of Logitech is product-centric. We joked a little bit because we did not have money for marketing, so we had to make great products. So and the company has remained quite a bit product-centric. Of course, it's quite different now, but the DNA is really with the focus around the product. But at the same time, we innovated in other areas. So we were very early in an omni-channel approach. So we didn't go with the idea of doing just one channel. We said, well, the world will sort out what works, what doesn't work. So we pushed it through, and whatever worked channel-wise, I mean, we adopted it. And we were pretty innovative there. We were the first computer product selling at Walmart, which is a very large chain of merchandise stores in the US. And we use design very aggressively since the beginning. Now, of course, in the computer world, I mean, the design is an important component. I mean, clearly Apple has sort of led the way that way, but we were there pretty early with some interesting design approach. We had a number of firsts. So often, when you do new enterprises, often being the first is good, and sometimes it's not good, because sometimes when you are the first, you might be a little too early, you might not be at the right timing, and so on and so forth. But many times, being the first works. So one of the things that we did was a cordless mouse. This is 1984. Okay, in 1984, we did a cordless mouse. This was infrared. It was for a workstation made by a company called Metaphor that then did not survive. And that our first retail mouse was cordless mouse was in 1991 with Mouseman cordless. This is a product that you might never see it. This was a handheld scanner. It was a scanner that you scan over a page over your desk, I mean, in segments. So you just scan it like that. I mean, you probably have seen the scanners, which are flatbed scanners. So this was one concept which came pretty natural to us. I mean, we had the mouse. It was something that you hold with your hands and on your desktop. and this is a product category that did very well. We launched it in 1988, and by 1993, the product just disappeared. So it just died. Okay, so, and you you might never seen it. It is sometimes the case. I mean, this is a typical example of a product category that came and went. And so if you were betting everything on it, I mean, then you would have been not in very good shape. We also did a digital camera. We were a pioneer in digital cameras in 1992. It was a pretty crude digital camera by today's standards, but and then this was a product where Logitech, at the beginning it was, I mean, it costed $1,000 at the time, which was a lot of money in 1992. Was 376 by 240 pixels, so very crude if you want. We were in the market for quite a few years, and at some point, and the market was not really picking up. I mean, it was a little early, and the quality was not that great, and so on and so forth. So by 1997, Logitech decided that we have tried now for 5 years. I think we gave up. We gave up a little early, so sometimes, again, you persist for too long on a product that doesn't go anywhere. Sometimes you may get a little bit early. This one we got a little bit early. I mean, then later on, I mean, 20 years later, it would have disappeared anyway because it's or mostly disappeared because your phone is now your camera, but it's an interesting thing. So these are some of the early stage things. One thing that was very important and really differentiated us quite a bit is that we were really global from day one. So we started in Europe, we moved to the US very quickly. We were dealing with a Japanese company already in 1981. We went in 1986, we went to Taiwan for manufacturing and then for engineering, and that was really very early. We opened a plant in Ireland in 1988, and then we closed, and now there is an engineering operation in Ireland. We went to China in 1990. Nobody would go to China in 1990. Okay, this was after Tiananmen Square. Nobody would touch China. Okay? But you had to you had to take your chances. Okay, so that's a little bit of the early days of Logitech, which is sort of an interesting thing to look at. Nitto Robotics was another consumer electronic company that I ran, and it had several things in common with Logitech in a way. I mean, consumer electronics, again, the channels were similar in a way. There were some firsts there as well because the innovation of Nitto Robotics made a robotic vacuum cleaner. Then the company was sold to Vorwerk, and Vorwerk has now discontinued the brand Nitto. They only sell it under the Vorwerk product right now, the Vorwerk brand right now. The major innovation of Nitto Robotics was that Nitto used a laser mapping technique, very similar to what you might have seen in San Francisco, the self-driving cars, the Waymo, the Google self-driving vehicles. So laser scanning, laser mapping, very precise, very interesting, and we were able to do it very inexpensively. So we were able to do a SLAM tracker that was very, very inexpensive, and that allowed to do a consumer product that can be sold for $300, $400, $500, $600. Okay. We had a strong market position, number 2 market share in North America when I was there, and then was acquired by Vorwerk in 2017. Okay, so Noventi Ventures, that's is actually in between. I started it in 2002. We invested we invested in 24 companies, and so that's still operating, even though a little bit slower than it used to be a few years ago. A few of the investments: Cygate, important investment acquired by Symantec. Easy Market was actually an Italian company. Velomant is also an Italian company. NextLab is an existing company in the data security space. So some interesting companies there. Okay, so that's a little bit about myself and my experience, what three things done, among other things. Now let's talk a little bit about Silicon Valley. So you came to Silicon Valley. So Silicon Valley. So first of all, where is Silicon Valley? Okay, at the beginning, Silicon Valley was the southern part of the peninsula. So it really started, if you really look at the origin, it started in Mountain View. It was going from Mountain View, south of Mountain View to San Jose, okay? And then over time, it sort of expanded. It was really semiconductor oriented. That was the main companies at the beginning. They were semiconductors. And then it sort of started expanding on one side, and then it expanded on the other side of the Bay Area as well. And then about 20 years ago, started in San Francisco. Until 20 years ago, there was no technology company in San Francisco for a number of reasons. There were the lawyers, there were the bankers, there were all kinds of other people, but there was no technology company. Then some of the software companies, Google opened an office, LinkedIn started there, and Twitter after a while. And so then there was a little bit of a concentration in San Francisco. Younger people started liking being in San Francisco and all that type of stuff. So that has been growing quite a bit. Now it's shrinking a little bit in San Francisco, but really when you look at Silicon Valley at this point, you have to look at this pretty broad area that goes from San Francisco to South San Jose and on both sides of the Bay Area. And this is an area that has about 5 million people. So San Francisco is small. San Francisco is 1 million people. It's less than 1 million, 900,000 people. San Jose is a little bit bigger, 1,000,001, okay? And then all the rest, like here, okay? So what is Silicon Valley? So there are lots of, people think of Silicon Valley, people think of technology often, people think of new enterprises, people think of inventing new things, and so on and so forth. My definition of Silicon Valley is that Silicon Valley is a factory of new enterprises. So the most important thing, the most important skill set in Silicon Valley is how to create new companies. So then it might be in technology, it might be in software, it might be in semiconductors, it might be in biotech, it might be in services, okay? It doesn't matter. The sector, the technology, it's less important. The fundamental skill is that how do we create a new enterprise, and then on top of that, that potentially changes the world, okay? So the ambition is big. So typically, so it's not just a product, technology, idea, it is a project or a new enterprise, okay? And one of the things that distinguishes the Silicon Valley approach, for example, if you compare it more to a European approach, if you want, is the outside ambition. So people think very big, okay? We'll change the world. We'll do something that will obsolete Microsoft, like Microsoft obsoleted IBM before, or whatever, that type of stuff, right? So the big ambition is a very important thing, and also then creates the serial entrepreneurs because the skill set is to create new enterprises. You just don't do it once. You do it many times. So the serial entrepreneurs are people that start a company, bring it to some level of development, and then hand it off to some other people, and then go and restart something else. Okay, So there are lots of people here who are really good at taking the company from zero to some size, okay? But they are not the ones that will run the company when it's $1 billion company, okay? There is a different type. And this is important to understand, because often in Europe, people think of a company like staying forever with that company, okay? And I think that has its limitations, because it's not based on the ability to create new enterprises, okay? Okay, so then the other question often is that, well, how can we repeat or reinvent Silicon Valley somewhere else? And often is difficult, because often one does not understand what are really the fundamental principles that make this machine work, okay? And in my experience, the fundamental principles of this system are based on a free market for talent. So what happens is that talent moves around in search of opportunities. So it's not a static position. It's not a static position in terms of employment. It's not a static position in terms of what you think. So it's a free market of talent, so which creates high labor mobility, which is a challenge, because clearly, I mean, people that work for you, I mean, at some point they will leave, okay? You need to get used to that idea. I mean, the people will not stay with you forever, okay? So that's so the mobility, and that also attracts, so there is a fundamental market for talent. And the second element of this is that the sharing of equity between talent and capital. So the shares of a company, traditionally, I mean, if you go back 50 years ago, okay, the shares of the company belong to a capital. And labor is paid to work for the company, okay? But the shares of the company were belonging to the capital. What happened here is that in this free market for talent, the exchange currency becomes the equity. So the equity does not belong anymore just to the capital, but is shared between the capital and the talent. Okay, so the capital put money, the talent put talent, and then the equity is shared in some way. I mean, and that's part of the financing process. So if you don't have this type of mechanism, it's very hard to reproduce the element of the Silicon Valley ecosystem, because that's very fundamental in what happens here. Okay. Then, why this all works? It works because there is a business infrastructure. So you have the competencies, you have the marketing competencies, you have the financial competencies, you have the technology competencies, you have everything. Okay, might be expensive, might be complicated to get, and so on and so forth, but it's available. Okay, it's available. It's the building next door. So it's where you find people that can help you to build your company. The culture, and one very important element of the culture is the acceptance of failure as a learning experience. So you remember I said at the beginning, looked at 2,000 business plan, funded 25, right? So, I mean, some of these companies were funded by somebody else, but some were not funded by anybody. And not only that, I mean, and some that were funded failed, okay? So the failure is not the end of it. The failure is one step, like success is one step, okay? So failure, so people may fail, but they accept the idea to restart again, and the ecosystem understands that failure is also useful. Ideally, for a venture capitalist, the the best entrepreneur to fund would be somebody who has had 2 successes and 1 failure. Okay? So you learn from the success, but you also learn from the failure. Okay? So that's quite ideal. Okay? And then over time, it has developed this ecosystem of large firms and startups. So Google now, it's a very large firm, right? Okay, they used to be a startup, 20 years ago, right? And so this ecosystem helps in many ways. And we'll see towards the end, some statistics, where the large firms are also big acquirers. So they provide an exit strategy for the startups. And also they source of human capital and expertise. So when your company becomes a $300, $500 billion company, okay, you want somebody that has the experience of running bigger companies, right? Okay, and the presence of the large firms helped you to recruit people. And again, we go back to that concept of the free market for talent. There is an important government role. In the US, people don't like to talk about the government role. Government in general is not a good thing for most of the people in the US. But the reality is that there is an important government role. In particular, government as a customer. So government is a very big customer of new technologies. And so right now you look, for example, at security. You look at the space exploration, which is all funded by NASA at the end of the day. It's all funded by the public, but it's now moved into private hands and so on and so forth. And then the competitive context. So there is this, sometimes people use the word competition. You compete and cooperate with the rest of the ecosystem continuously. So that is a positive in overall, because it really allows for you to know what is going on around the world. And you have to give some of that information in order to get some of that information, but it's a good compromise, and then the result tends to be a better result for everybody if you do it right. Okay, so this is about, there should be a little bit of a philosophical view of Silicon Valley and what are the elements that make it work and click, and be glad to answer questions later, but let's go. So venture capital, so you probably have had some exposure to, you have heard of venture capital, and what is venture capital? Venture capital, professional managers that provide equity capital. So that's the other thing you need to remember. These are not loans. These are not bonds. These are not, it's always equity. When there is a loan, it's a short-term security. But there are companies that they cannot get capital in other ways, just because they don't have history. Okay, they don't have the history, they don't have the assets, they don't have the size. Okay, the venture capital structure is that you typically have the investors. So in the US, for those of you who go to business school, in the US, the structure of a venture fund is a limited partnership. A limited partnership è una società in accomandita. Okay? Ci sono i soci accomandatari, i soci accomandati. Investors, and the reason for that I'll explain in a moment. So you have the limited partner, you have the manager, who is the venture capital firms, and then you have various funds. So normally there are several funds which various investors and managed by the same venture capital firm, and then you invest in several different companies. So it's a limited partnership, and I'll explain it to you in a moment why is that, why it's used as a limited partnership. The capital flow, it goes in and out as needed. So when people say that a venture capital firm has raised 100 million, it doesn't mean that they have 100 million in the bank. they have a commitment from the investors to write checks for 100 million. And the checks will be written as needed by the venture capital firm. So as the venture capital firm makes the investments, they call capital and say in percentage of the commitment of the various people. And also the capital is returned as soon as there is a liquidation event. So the venture capital firm never manages cash. So cash comes in when it's needed, and if cash is gained by a liquidation event, it's returned to the investor. The funds are typical 10 years, even though most funds right now stretches to about 15 years. So it's a long commitment on the part of the investors. So you put the money there, you have to wait a very long time before it comes back, if it comes back. The so-called investment period, 5 years. The first 5 years, you put money to work, you put it investments in companies, and then the rest you try to generate liquidity, which is often not very easy. Normally you pay a fee. The economics are you pay a fee, which is typically 2% per year. And then if there are profits, what happens is that the profits are shared 80-20 or let's say 70-30 between the investors, the people who put the money, and the managers. So if there are profits, the investors get 80% of the profits, and the management gets 20% or 30% sometimes. I mean, if you are a very successful venture firm, you can demand a higher share of the profit. That's inside the fund. The fund. Venture capital firm is the organization of the managers. So those are the managers. So if we go back to the prior, so the investors get 80% and these guys get 20%. Okay, out of this fund. Okay, out of this fund. Okay, so who are the investors? Okay, so often the fantasy says, well, okay, these are rich people. Actually not. The largest fund investors in the US are pension funds. And let me give you an example. So CalPERS is the pension fund of the employees of the state of California. So the state of California, pretty large state, 40 million people, has a pretty large organization. So the employees have the CalPERS is a $500 billion organization. So CalPERS manages $500 billion in assets, which comes from the contribution of the employees for their pension and then distribute the pension later. So CalPERS has about 3% in venture capital. So that's $15 billion. Okay, so the numbers are significant because they come from pools. They are small percentages of very large pools of money. Okay. The other thing is endowment and foundations. Endowment and foundation, for example, Stanford University. Okay, so Stanford University is a private university, has an endowment. So the founders of Stanford University put some money in there that sort of is a permanent source of capital. Okay. Stanford University has an endowment which is about $50 billion. Okay, so again, these are all big numbers by Italian standard. Okay, so $50 billion, and Stanford has about $2 billion in venture capital. Okay, so it's a lot of money. I mean, why these guys invest? Well, these guys invest small, prudent amounts in order to potentially generate higher return over time that the public market would give you. And the other important thing is that, you remember we said, well, 10, 15 years. So these are very long funds. Not only that, when you look at venture funds, often, if you want to invest in venture capital funds, you have to keep in mind that you have to invest in several funds because one one specific fund may not perform well. So, but maybe if you invest 3, 4, 5, 6, but then you start looking at the time horizon, okay, the time horizon is very long. So you invest in a venture fund this year, maybe 3, 4 years from now you invest in a second venture fund, 4, 5, 6 years from now another venture fund. So in 10 years you have invested in 3, 4 funds, okay, maybe in the same family, but these things then now you are looking at 25 years horizon, okay? So you need permanent capital. So you need very patient and very long-term capital to be in that mindset, okay? Then investment funds of various types that invest money over the people, and then family offices come in, okay? So the family offices, rich people, family offices also, they typically invest some allocation, but quantity-wise, they are not at the top of the list. They are somewhat down here, okay? So the we can probably skip this. Okay. So venture capital. So the investment cycle is that you will, when you hear about venture capital, you will hear about various stages of investment. So seed, Series A, Series B, and so on and so forth. Why you do this? Okay. Why don't you put the money all at once? The main reason is risk management. Many of these companies are going to go belly up, okay? So they are going to fail, okay? So if you put all the money at first, you have lost all the money that you could put in that company. So you put a little bit, wait how it develops, and then maybe you put a little more, maybe. In doing that, you reduce your possibility of returns because clearly the money that you put at the beginning typically is at a better condition than the money that you put later, but on the other side you manage risk, okay? So that's the number one reason. There are some other tweaks on the reasoning, but that's the biggest difference. And that's very different from what happens in private equity. Private equity typically invests in an established company, so if they want to acquire 30% or 50% of the company, they acquire it all at once. While in venture, that's never the case. Okay, it's always stage. And in most cases, it's syndicated. So there is a group of different investors that come together to invest. So it's never one single investor. Again, that's a little bit different from private equity. And that's, again, to manage risk and also to expand the network of people that can help the company grow, because it's going to be a long journey, and so the most help you can get, the better it is. And venture capital is temporary capital. Venture capital is capital that comes in and has to come back. Okay? Remember, it may take 10 years, okay, but it has to come back. So venture capital is not a holding company, okay? Venture capital is temporary capital that comes in and has to come back. So as a founder, you need to keep that in mind. When you take venture capital money, you have to think that at some point the capital will have to go back, okay? And how it goes back? It goes back typically to an acquisition or to an IPO. Those are the two main things. There are some other variations, but and the valuation metrics, both on the investment side and on the exit, are not often the typical valuation metrics for traditional companies, which are often based on multiple of earnings. Here you look at the growth rate, the strategic value, the price-revenue ratio more than the earnings themselves. So how all of this started? So the story is interesting. So there are various versions of the story, but this is probably a pretty solid one. So in 1957, there was a company called Shockley Semiconductor. Shockley is the person who invented the transistor. He used to work on the on the East Coast. He became professor at Stanford, and he started a company. And then he had a bunch of people working for him, okay? And he was a very difficult person to work with. And so 8 people at some point said, we have had enough, okay? We are going to go and do something else, okay? And they were called the Traitors 8, right? So these people said, well, okay, we are going to do our own semiconductor company, okay? But they needed capital. So they had talent, but they did not have capital, okay? So they needed capital. So they went to a young guy called Arthur Rock, who spent 18 months. And at the end of 18 months, he convinced Sherman Fairchild to give them $1.5 million at the time, which was a lot of money, 1957. And they started Fairchild Semiconductors. Okay? So that was sort of the first venture-backed company. Okay? Then this Traitors 8 ended up, because again, the story I told you before, you move to the next opportunity. You don't get stuck there. So these 8 people were founders of 64 companies, okay, over their life, okay, including Intel. So Bob Noyce was part of the 8, and he was one of the founders of Intel. And then in '58, there was an interesting law that passed. There was a Small Business Investment Act that helped a little bit the way the venture capital structure was shaping up. And then some of the early stage ventures, Davis and Rock, which does not exist anymore with that, 62 Draper and Johnson. The Draper people, then there are today Draper firms, even though it's a little bit different than they were at the beginning. Kleiner Perkins and Sequoia, which are some of the most successful companies in the space, was founded in 1973. And National 72, 73, National Venture Capital Association was founded in 1978. Before 1978, the pension funds in the US could not invest in venture capital, okay? In 1979, there was a revision of the prudent man rule, which is the criteria that the pension fund has to use. So the pension funds in the US will have to invest as a prudent man, okay? Whatever that means, okay? But that at some point it said, well, investing carefully in small amounts in these high-risk investments can be done. And so that opened up what I showed you before, that then made the pension funds the largest investment category in this space. Okay, so how much money are we talking about here? Okay, so in the US, these are US numbers. So in the US now, this is a very big business. It's grown a lot. So right now, this is the number of 22. I did not update, but capital under management is $1 billion. Sorry, it's $1 trillion. It's $1 trillion, 1,000 billion. Okay. It's grown quite a bit. I mean, in 2004 it was 163 billion, and before it was still smaller. So how is this invested? So out of that is the asset under management, which includes all the commitments, basically, as I said before. So 2021 was the highest year by far. I mean, 2021, 350 billion were invested in 17,000 companies. Okay, so the size of that is big. There is a lot of stuff. And out of that, 40% of that is Silicon Valley. Okay, so there is a strong concentration. I mean, it is overall in the US, but this is Okay, so what is this? Deal activity. Okay, so so sorry, that's a duplicate of the prior one. Okay, so this is so you see the number of deals is basically from 10,000 to 20,000 to about 15,000 financing deals per year. Now, of course, after the peak, things are getting a little bit more normal. So they came down the number of the money invested came down to 170 billion. That's the money that goes in. How is the money coming out? The exit activity in the US, so if you look at this, so in 2021, there is no coincidence that when things go well from the exit standpoint, then people are very encouraged to invest a lot. So in 2021, you had $710 billion of exit realized. So that's very high, extraordinarily high. That's twice the amount of the money that went out. But in most other cases, if you remember, back here we were talking about 150, 200 billion going in, and only 100 come back in. So not all the, typically only 25% of venture funds make money. Okay, 75% lose money. Okay? So it's a very volatile investment. So let's see. So we said before you generate liquidity either by an acquisition, which is in blue, or a public listing. This is the list, and then there is buyout, which we can talk in a moment. Okay, but let's focus for a moment the public listing, the IPOs, and the acquisition. As you see, the number of merger and acquisitions is easily 10 times the number of IPOs, okay? But then if you go to the other side, you will see that the money generated by the IPOs is typically very high. In 2021, I mean, was extraordinarily much higher than the money generated the merger and acquisition. And that's typically true over time. I mean, it goes up and down, but that's quite true, okay? So the most companies, okay, so let's go fast. So briefly, I mean, I've been involved a little bit with Italy. So in Italy, so venture capital in Italy, so the venture capital business is developing in Italy, has been developing. The history is roughly like this. In the 80s, Olivetti was the only venture capital operation of with Italian money. Biol, Elseino Biol was the managing that at that time. In 88, Elseino Biol had left Olivetti. Biol and Novik started Pino Ventures. Pino Ventures became famous because they make the Tiscali investment. Now, Tiscali, I mean, is sort of, but for those of you who are a little bit older, you might remember Tiscali a little bit, okay? Cheerlab in 1999 was the very first incubator, which was part of Cheer, which is the Benedetti group, so it goes back to the Olivetti origin, if you want. And I was involved, I was on the board of Cheerlab. And then everything disappeared at the end of, everybody went home because the market went down by the year 2000, 2001, so everybody. And then in 2012, there was a reorganization. Rado Passera was the minister of Economic Affairs. He built a task force of 12 people and came together with the Startup Act of 2012 that made things a little bit easier for the venture capital business and the startup business to develop in Italy. Okay, so the numbers. So if you look at 2000 and 2023. So if you remember, the US was over 200 billion invested. In Italy, you had $1 billion invested. Okay, so that's a typical number. The number of deals. Okay, so the number of deals less than 100. The exit less than 20. But overall, it's growing. So it's growing, not very rapidly, but it's growing and then getting more serious. And so I think, there is a good path. I made a simple comparison. So in 2023, we're talking, so $1.3 billion. Those were euros before, so 166. So the US is 125 times the investment amount of Italy. Okay, the GDP ratio is 13 times. So the US GDP is 13 times the Italian GDP. GDP per capita is a little bit different, but and you can see the VC deals, so it gives you a little bit of an idea. So it is at the beginning. It clearly it started 35 years after the US started. So and just to give an idea, the global investment, this is 2022, so not necessarily yet comparable, but the US is about, call it 1/2 of global. Okay, economic impact. I'm getting to the end. So until about 10 years ago, the National Venture Capital Association was publishing a report of the economic impact of venture capital. So it was saying, okay, so what has this generated? Okay, then about 10 years ago, actually, later 12 years ago, they stopped publishing it. Why did they stop publishing it? Because of this chart. So if you look at the 5 largest market capitalization companies in the US, they are all venture capital backed. So there is not, you don't need to write a 300 pages report to see what the impact has been. So today, the economy of the US is vastly dominated. If you take the top 10, I think 7 or 8, depending on the day, are venture capital backed. So the US economy has been reinvented in the last 50 years by venture capital backed companies. Okay? Then you can look at some of the other statistics back and forth, okay, and you can see that the numbers are quite striking. Okay? So even though it is a very challenging category to invest in, there is a number of failures and all that type of stuff, you can see that in the US this has had an extraordinary impact. Okay? And then another important chart is the following. Some of those companies that started as startups, those have become the largest acquirer of startups in the US. Stop here, take questions. Yes?